Hi, I'm Mal from the Money Study, bringing you another episode of our Take Challenge, and we're up to number 92, all about buying an investment property. Going to be a few sections on this one, so this is part one. Initially, why buy it in the first place? How about using some leverage, making our investment work for us? There's our disclaimer, facts and figures, information only. There is no advice in today's session. So, why are we going to buy a property for investment purposes? Well, as we know, everybody needs somewhere to live, so it's a commodity that we are investing in that's got good demand, and that's any time we're looking for an investment, we are indeed looking for an investment where there's plenty of demand. And in Australia at the moment, they're telling us that there's a shortage of housing, and so in theory, by us buying an investment property, we're buying into a market that in theory should indeed continue to grow. There is indeed a short supply of affordable rentals across Australia, and of course the thing is with rental property, there is no such thing as the rental market. People talk of the rental market, but basically every particular town, every suburb is totally different. And you'll find in some places that there are plenty of houses available, others there's a dire shortage and so forth. So when we talk about this, we're really talking about doing our homework to find out what are going to be the good reasons to do it. It's an investment that's pretty easy to understand. We all understand that we basically buy a house, we rent it out, we basically get our rent comes in, pays for all our bills, and that hopefully their rent is indeed going to cover all of our bills, and also the fact that hopefully the house price will go up over time. And we're going to talk about this thing called leverage. The power of leverage can speed up wealth creation in the right circumstances. And we'll talk about that in a slide or two. But let's have a look at some of the pros and cons first. The pros in buying an investment property: regular income. Well, provided it's rented, it's regular. And in theory, most people pay their rent either on a weekly basis, for fortnightly, monthly or so forth. But it's regular income as long as you've got a tenant there. Good tax deductions. The debt that we've got against the property is a tax deduction. The running costs, all of our insurances and things like land taxes and all the other costs indeed of running the property are all good tax deductions. It's a physical asset, meaning we can touch it, we can see it. It's not like some sort of investment which might be things like bitcoins and so forth, which are certainly not quite as tangible. Certainly understandable. It's one of those things that is, I'll say most people get the idea of what a investment property is all about. Capital growth, meaning that we can indeed buy a house and hopefully over time it will go up. And if we've got debt and borrowed money, then in theory we can get more leverage from that, which again, we'll talk about that in a slide or two. It seemed to be less volatile than things like shares because of the fact that really you don't get your house priced every day. So we don't see our house go up and down every day, whereas obviously in the share market we can indeed see falls of 1.5% or so in a day quite regularly. We don't get to see that on our property. So people think, oh yeah, my house hasn't moved in 6 months. Some of the downsides: high purchase costs, so you can't just sort of buy a bedroom. Well, having said that, there are ways of doing that with some of these apps called things like Brick, where you can actually own portions of houses, or there's property trusts and other ways. But generally speaking, if you're looking to buy a house in your own name for an investment purpose, it's going to cost you a reasonable amount of money. Very dependent on interest rates. So as interest rates go up, if we're borrowing money, then of course our costs are going up. Now, of course, if you can afford to buy a house without borrowing money, interest rates really aren't a problem. However, interest rates do intend to have an impact on what people are charging on rental yield on your rent. It's inflexible and it's illiquid, meaning you can't just sell off a room. If you need some money, you need 40,000, and only money you've got is tied up in investment property, you've got to sell the whole investment property. We can't just sell off one bedroom. And it's a liquid in the regard that, unlike shares, you can hit the button to sell, and pretty much you can guarantee you've got your money landing in your account. Generally speaking, in a day or two. But with the situation with the house, yep, could take, well, even bare minimum 30 days. But by the time you actually promote it, sell it, find a buyer, and sell it, and then effectively have all the legal done, could be 30, 60, 90 days or much longer. So people could obviously, from the time they decide to sell to get the money in their hand, could easily be 6 months. We've already said it's high cost to purchase, also a high cost to sell, and therefore, high costs of purchase and selling, meaning that there are indeed the things to sell your house. You might need to get a rental manager, real estate manager to sell this thing for you. Advertising costs to sell it. So obviously to buy, things like stamp duty, all sorts of other costs in getting in and getting out. So it can be quite an expensive transaction. So it's something that you really got to take into account. It can be vacant. So while it's vacant, no income. And of course, you've all heard the horror stories about people basically breaking up your house, and that's where landlord insurance and has sort of contents insurance and so forth might be useful, but certainly not a pleasant thing. And of course, there is this possibility of negative equity, meaning that if house prices drop significantly and you've borrowed pretty much close to the value of the property, and then the house prices drop by 20%, then effectively the sale of the house wouldn't even cover the debt. And so our debt is bigger than the value of the house. And certainly not nice to have a debt bigger than what the purpose of the debt was for. So let's have a look at this thing called leverage. Generally speaking, most people need to borrow money to purchase an investment property. Now, if you've got a lazy mill lying around, well, okay, fine. But then again, there might be other things you could be doing with that money. But if we're going to buy an investment property, generally speaking, we need to borrow some money to purchase the house. And any time we use borrowed money for an investment, it's called leverage, because this borrowed money can indeed speed up our wealth creation. First of all, the interest on the loan is a tax deduction, and that sort of helps us with our tax perspective. But remembering it's only the tax is tax deductible only on the interest, not on the principal of the loan. So if we're paying the loan down, that part of it is not a tax deduction. It's just the extra interest that is applied to the loan is indeed the tax deduction. And so you'll see people talk about debt being good debt, bad debt, that if debt is on like a car, or for your latest clothes or a holiday, that's obviously that debt is not very good. Debt that's applied to something that actually makes us money can indeed be classified as good debt in the regard that it's assisting us to indeed improve our situation, hopefully. So let's have a look at an example. Firstly, just think about somebody who's got $80,000 to invest. They're not going to borrow any money, and their investment, they put it into some form of investment, whatever it might be, and the investment goes up by 10%. So they've got 80,000 invested, they got a 10% increase, goes up to 88,000, their profit is $8,000. So they made a 10% profit on their $80,000. But consider the same person who's got $80,000, they use it as a deposit on an investment property, let's say worth $500,000. So they're borrowing $420,000, and then the property goes up by 10%. Well, okay, our property's gone up by 10%, so now it's worth $550,000. We only really used $80,000 of our own money, and therefore the $50,000 that went up by is now compared to the $80,000 of our money used. So you can sort of see there that our profit on our utilised money certainly can be revved up. Of course, in this, it's a pretty straightforward example here. I'm not taking into account any sort of expenses and so forth. Obviously not quite as nice as that, especially when we start to talk about things like capital gains tax and other issues, and I will go through this in later sessions. Not always as nice and clean cut as some of these property developers and spruikers will have you believe. But anyway, look, but in theory, yes, applying a bit of leverage for our investment can be good. Of course, it works the other way around, that if we get losses and we've borrowed money, not quite as attractive. So if our property goes down in value by 10%, then our losses are amplified. So if our loss was $50,000 from our $80,000 invested, ouch, not a nice situation. So this can help, but it also can hinder and can be obviously very painful in nasty situations there. Now, if all the expenses to run the property during the time of ownership are considered, and then adding all the buy-sell costs, the losses are even greater than what we've pointed out there. And could it be indeed we've effectively lost all of our money plus more? So this is where, buying a property to me can be a very, very smart idea. But is it sensible for someone perhaps who's at the age of 60? And we'll talk about this concept in future sessions here. But we need this to be a longer term investment to ensure that all our buy-sell costs are taken into account, that we made some benefit from the leverage and so forth. And if it's a case that we need our money to retire, it's interesting. We'll talk about this in future sessions to come. Happy to have a chat anytime, and there's our email address there at the bottom. See you on part 2.